Obviously, even over the last 10 years with social media, reaching a broader group of people has become so much easier.
Welcome, everyone, to our Hero Capital show. I am your host, Tim Mai, and today I have an amazing all-around lender, syndicator in the space, very experienced in the space. Super excited to have him on, Mr. Anton Mattli with Peak Financing. And Anton has decades of experience in commercial and investment banking, private equity, and commercial real estate. After graduating from Zurich Business School in banking and finance, he held senior management positions at major financial institutions in New York, Tokyo, Hong Kong, and Zurich. Over the last 15 years, Anton has been advising family offices, high net worth individuals, as well as private investment funds, facilitating their direct investments in commercial real estate across Europe and in the United States, amounting to several $billion in multifamily and other commercial real estate developments and acquisitions. And outside of the office, Anton enjoys spending time with his family and is involved in various community-based organizations. When not helping one of his clients with a multifamily financing, you will find him hunting down the best powder for skiing in the Rockies. And Anton is fluent in both English and German. So I'm going to do this entire interview in German.
Go ahead. I
Welcome,
won't
Anton.
judge you.
All I need is ChatGPT, and I should be good. But yeah, let's start. I know your background goes quite a bit around finance and things, but I'm curious as to how you got into this world of syndications and financing into the so tell us a little bit about your background, and then especially on how you get into this world of financing syndication deals.
Yeah, sure. So, as you mentioned, I was born in Switzerland, went to school in Switzerland, and as many people in Switzerland do, either you are into watchmaking, chocolate making, cheese making, or you go into finance. And I happened to go into finance. And after I graduated, I wanted to go to New York because New York back then in the 90s was the place you had to be for investment banking and banking in general. It's frankly still the case today to a large extent. So that's really why I wanted to be in New York. So I worked there for 5 years, and as you already mentioned, I had opportunity to work in Asia for roughly 7 years. After that, because my family never saw me during that time, for anyone who is in this world, they will understand that you essentially just work and travel, and it's not exactly healthy for a family. And I wanted to, my wife as well as my kids actually see me growing up. So that's why I left that world and we started our own business. And we've advised family offices in Europe. And as a result, we also had a couple of developments in the US, and one of them happened to be in Dallas, and that's why we actually ended up in Dallas, where we are today. So it was more kind of a business-related coincidence why we ended up here in Dallas. And as part of that, because it was a number of large commercial real estate deals that we worked on, we realized that the financing side, we could not really rely on just a lender telling us what the financing is. So we really had to dig in deep. We had to find additional sources to get the best financing in place. And that's really how it started out for our own needs, where we then expanded that also to broker it for other parties. And you asked me, how did we end up in that syndication space? Initially, it was really because the syndication before the Jobs Act was not really a thing, right? So it was mostly private individuals, families, small equity funds, private equity funds that did their deals, apart from the institutionals, obviously. But syndication as we know it today didn't really exist until the Jobs Act was coming into play. And as a result, it was a natural move for us, since we already did arrange these financings for individuals and families and smaller equity funds. It was a natural progress for us to also help syndicators. And so that's where we started essentially out when the syndication space exploded roughly what is that now, 13 years ago, 13, 14 years ago. And as we have had a very good run until 21 and 22, and then we had some market correction, and now here we are today, I think, or in a very interesting time where we can pick up quite a bit of good deals over the next 12 to 24 months. So that's how we progressed into the syndication space.
Very good. Yeah. I would love to go back to history a little bit. What was, you mentioned before the Jobs Act, it was more like family offices that do these deals. Was it more of a JV type structure? Like they didn't bring in any retail money? Was retail investors not able to get into those deals back before the Jobs Act?
Yes. So we have never worked with any syndicator until the Jobs Act came out. So were there some deals that were done with money raising and with JV structures? There certainly were, but there were not that many, at least not many that I was aware of. When we look at commercial real estate for smaller properties and certainly multifamily pre-Jobs Act, you had two major areas, right? So one was the institutional space. So the institutional players have always been in that space. And that's really where I started out originally. And then when it comes to the middle market, as we call it, it was mostly wealthier families, wealthier individuals that covered that middle market space from 10 million to maybe 50 million of property values, and mostly really 10 to 20, maybe 30 million. And then below that, especially in that 1 to 5, maybe 10 million space, it was mostly private individuals, right? Or families that just happened to own properties. It was usually they own properties for a very long time. It was really a long growth phase everyone went through. It was not really meant to, okay, let's buy today, let's rehab and sell a few years later. Most during that time were holding these properties for a longer period and mostly for themselves. And frankly speaking, you could buy properties, even a 50 or 100 unit property, because prices were so reasonable, even as an individual or as a small family. So it's a 100 unit property then cost 10 million plus, right? It was comparatively much more affordable, but it was too small really for the institutional players, right? So that's why it was mostly private small funds, small family offices that played in that space. And it was not really a thing to syndicate these type of deals at all. So that's before the Jobs Act, and obviously then, as we know, that created a completely new business environment and investment environment.
Right. So what was in the Jobs Act that created this whole new opportunity?
It really allowed to raise money with these private placements. You had private placements before, but the way it could be done was so much easier and with much less hurdles, and so it allowed in a very streamlined fashion to establish a private placement offering and then go out to private individuals, whether it was again with the 506B or the 506C, so that one could do that without having to go through major hurdles and reach a broader group of people rather than just some smaller family members or anyone else. Someone already had a long-standing relationship, and that was certainly with the 506C, as that was a big benefit that you could advertise to a broader group of people. Now, the interesting part is I do not know what the breakdown is. The 506Bs are still the majority of all these offerings, despite the fact that you have access to 506Cs and are freely able to advertise. So that, in my view, is still a very interesting observation. And obviously, I'm not privy to that, what the exact breakdown is. But based on what I've heard from Mauricio and some other lawyers that are operating in that space, that is 506Bs still make up a significant portion of all of it.
Yeah, I can imagine that. And I think that as technology and being able to advertise like on Facebook ads and things like that, I think that the C has been, especially in today's market, it seems it has gained more popularity just for the purpose, for the ability to run Facebook ads directly to it. So yeah, I've seen syndicators that go straight. I know some of them will start with a B, convert to a C, and I see some that go straight to a C and just run Facebook ads, like even when they're fairly new and don't have a lot of investors. And so it's really cool to see that's where the market is going. And the investor obviously is open to that, right? They don't necessarily have to have known these operators, these deal sponsors for a long time before they invest. So the market's definitely evolving. It's interesting to
Yeah,
see.
definitely. And obviously, even over the last 10 years with social media, reaching a broader group of people has become so much easier. Right? Yes, we have had social media platforms 10 years ago, but it was still a niche at that point, whereas today everyone is on Facebook, everyone is on LinkedIn, virtually everyone. Suddenly, younger generation is on Instagram. Right? Never mind TikTok. I don't know whether you guys are active on TikTok or not, but certainly LinkedIn and Facebook, I would say, have just exploded, and virtually everyone is on at least one of those platforms.
Yep, exactly. All right, let's talk about the syndication space for a bit. As a lender, you know a lot of what's going on in the space, and you get to see how some of the deal sponsors have been navigating through the challenges. Speaking to that, share with us what are you seeing behind the scenes, and we'll start with that, and then I'd love to get your crystal ball view on when we can be out of this whole thing.
Yeah, sure. So we really have two different worlds, right? Everyone is essentially a syndicator, right? Whether you're an institutional investor or a startup syndicator who raises money for 2 million from investors. When we talk about syndicators, we usually talk about private placements. But in reality, virtually everyone who is out there who buys large multifamily and commercial real estate is a syndicator in one form or another, right? It might be a REIT, it might be a fund, but essentially it's still raising money from investors and then investing that money in most instances, right? There are always exclusions, but when it comes to the institutional players, the majority of them are essentially just money managers. And by that measure, we should look at them also as syndicators. They are just much more sophisticated syndicators, and they have access to many more tools. They have access to much better financing. When we look at where we are in that space today, we had that peak in 21 and early 22 when interest rates were at record lows. Everyone was buying up multifamily and commercial real estate like crazy, but especially multifamily in the syndicator space. Since then, we have gone through a significant correction with values down, depending on market, 20% to 40%. We have seen properties, depending on what market they are in and for how much the buyer bought them in 21, where the prices are now on the market for 50% of what they paid in 21. So it's a pretty significant reduction there. And when we look at the institutional players, they have recovered relatively fast, right? We also need to understand that the institutional players then never really have been using leverage levels as what the syndicators tended to use, only doing 21 and 22, where everyone was pushing for maximum leverage, very often bridge loans, 80% loan to cost, sometimes even more, whereas institutional players always have operated in that 55 to maybe 65% LTV, right? They never really pushed, in most instances at least, never pushed the leverage to the level of what the traditional syndicator, as what we talk about syndicators, have been using. And as a result, they are not hurting nearly as much as the typical syndicator, even though they may have also overpaid for properties during that time. So they are still able to refinance. They also have access to better funding than the typical syndicator would. And so for them, the pain is not nearly as strong. That doesn't mean that they do not also have properties in their portfolio that are struggling. So there's only a number of REITs where I would say that their net asset value is probably not exactly reflecting the market value, but that's where they value them currently. But they certainly have the ability to still get very attractive financing. So now when we have contrast that with the syndicator space, as what we talk about with private syndications, that has only had a significant impact on how a syndicator is able to get financing, as the equity raising has become extremely challenging for most syndicators, even those that have been in the business for a long time. And on the debt side, it is certainly more challenging too. Financing is available. It's not that there is not liquidity in the debt space. I would say there are a lot of lenders out there that are willing to lend, and whether it's agency lenders, whether it's bridge lenders, they are ready to lend for the right project and for the right sponsor. The challenge very often is that they scrutinize a project much more than in the past, so much more than in 21 and 22. And they also scrutinize a sponsor much more than how they did in 21 and 22. So as a result, you may not get as attractive for financing as you would have received back in 21 and 22, lower leverage, maybe a higher debt service coverage ratio. And in some instances, a lender may just not be willing to extend a loan for a particular sponsor. So the scrutiny of the sponsors is definitely much higher. Lenders look at the real estate owned schedule in much more detail now. They go line through line, and if there is an issue with one property, then they want to have answers. What is the challenge that you have? Why is the debt service coverage low? What is the issue? And they assess whether that property or those properties that seem to be challenging in a portfolio of a sponsor, whether they potentially would have a contagion effect on the rest of the portfolio, as well as the new loan that they are asking now for. So as a result, I would say lenders are definitely much more careful, and it's particularly challenging for new deal sponsor, someone who just comes onto the market who has not a very long and strong history. But I would say it's not all lost. All what one really needs to consider is and ask the question, can I do that myself? Can I do it with my team? Or do I need to bring in someone else who can strengthen our team? So most deals really cannot be financed because apart from the property, if the property obviously is a challenge, then it's a different story. But in most instances, it's less the property, but more the sponsor team that is not strong enough. It would have been strong enough in 21, 22, but it's no longer strong enough today. So what I would advise for syndicators that are not especially strong, that they consider teaming up with others so that their strength is improved, and that will help with in getting financing done. But the strong teams, they still get the financing, right? So yes, the terms might not be as aggressive, but it's only available. And frankly speaking, it might not be that bad to get terms that are not as attractive, because that requires a little bit more equity, which means you as a sponsor have more of a cushion in the deal, which also helps you to sell that deal to your investors, because now you can say, look, we are not over leveraged, we have a lower leverage, we need to meet the debt service coverage, let's say, of 130, 1.35. So everything here in that deal is less aggressive, which gives us higher comfort that we can actually execute.
I see. Very good. And I used to think that the bigger operators, they have more resources and stuff, that they would have a higher chance of surviving through this market. But I've seen quite a bit of quote unquote bigger operators that are having deals losing 100% of their LP investors' money, or some part of that. Can you speak into like the operators that you see that are maybe a decision that they made prior, the way the buy box is prior to the market turn, or that they're doing something maybe because they're fully integrated, so they're able to operate their way out of the bad deals. But what are you seeing in terms of the operators that are doing well in navigating through this challenging market, operators that are not doing well in navigating through this market?
Yeah, when we talk about big operators, right, so that is all relative, right? So the really big operators, again, when we talk about quasi-institutional players, they only have the resources and they have access to capital to get through any of these trouble spots. There are always exceptions, right? So I'm not saying that all of them are making it through without any issue, but generally speaking, when you're an institutional player, your access to capital and your cushion is just so much bigger. When we talk about the larger players in the syndication space, there are vast differences from one player to another. Obviously, I do not want to mention names, but there are certainly some that have tackled the situation head on as well as early on. So they did capital calls as they were needed to get refinancing done. They didn't extend the bridge loans. They instead decided, let's raise capital so that we can pay down the bridge loan so that we can get into a permanent loan. So then we are all good for the next 5 to 7 or 10 years. And so they can sleep at night. And then you have, but that obviously usually are those that have already built a pretty strong track record where investors were comfortable with them. And they also were the first movers that actually made that decision. So those are the ones that are in a pretty good spot, right, or a very good spot. But then you also have some pretty large operators in that private syndication space who really did not raise money to pay down the bridge loans, but instead went primarily with pref equity offerings. First, they did capital calls. They may not have worked, or they did pref equity raises to extend the bridge loans. The problem with that is that it's really just kicking that can down the road, and you now have still that refinancing risk or sales risk that is still right at your doorstep with these deals. And you also have very expensive capital that now sits ahead of the LPs, right? So with these operators, I would say that the challenge is that they are still hoping that interest rates on the long end of the curve, right? I think everyone acknowledges that the Fed rate will come down over the next year or so, but that doesn't really help when it comes to refinancing into a permanent loan, nor selling the property when the 10-year treasury still hovers above 4%. So that's really their hope, that the 10-year treasury, and with that, cap rates also will come down, which hopefully will improve their valuation, and that they can refinance or get out of that bridge loan. And that's where I would say a lot of players have a challenge, whether they are smaller or larger players in that space. And I would say there are quite a number of pretty large syndicators, syndication groups that are in that spot. And it remains to be seen how they can get out of those various loans, because they really did exactly the same thing as smaller syndicators did, right? Attempt a capital call and or a pref equity. And very few actually said, okay, let's pay down the bridge loan and then refinance so that we can sleep at night. So everyone was mostly going into, let's just raise whatever we can so that we can extend the bridge loan. So that's, I would say, is really the challenge that we see. It's truly that extend and pretend mode that everyone has entered as syndicators as well as lenders, right? So obviously always need the cooperation of the lenders, and lenders essentially said, it's easier for us to just do another extend and pretend round than forcing them to sell the property or take the property back. And so far that has worked out. It remains to be seen how much longer lenders are willing to do that. I would say we have certainly seen a shift over the last year and certainly the last 6 months, where lenders are now recognizing that with some sponsors, it's not really worth it to extend further because the property will probably deteriorate more if they do that compared to taking it back and take over the asset management themselves.
Wow. Okay. Would it be correct to say if in the next 2 years interest rate don't go down, a lot of these operators that are doing the pref equity going to be in pretty deep trouble, even more so because now they have the existing loan, they have this new pref equity that they had raised for that they have to service. What is that time frame before if the market doesn't change where interest rate actually come down to for cap rate to come down that they would get in trouble?
Yeah, there are various pieces that could help them, right? Obviously, in a lot of markets, we had oversupply, right? So that supply is now slowing down. So the hope is that rents will move up, right? Now, is that going to happen? We will see. But that is only one of the hopes. At the same time, in some of the markets where taxes exploded, like Florida, like Georgia, and some other markets, with the revaluations that now everyone is going through with protests and all that, there is a chance to reduce those expenses. Insurance also has come down. So the goal there really is to improve the NOI, even if cap rates are not really coming down. So I would say for those that are really good at growing the NOI, they may have a chance to get out of these bridge loans as well as the equity and being able to sell without a loss. The question really is, so that's the best case scenario in my view. The question still is, and that's where every LP really should ask that question. Okay, so if that happens, how much of that pref equity is now ahead of me? And what is the, not just the current pay that is being paid, but also the pay that is still due at the end? And how much will that ultimately be between the senior loan and the pref equity plus the accrued rate on the pref equity? Is it realistic that I, as a LP, will see some money or not? And I would say the answer is, in a lot of instances, it will be a challenge, right? That the investors in these deals will actually see some money coming back to them, or if they see something, it's likely only a fraction of what was originally invested. Unless the cap rates come down significantly, this is likely to be the case in my view. Right. So even if you can improve your NOI, it's just a numbers game, right? The reality is you pay, as with equity, typically, even on the low end, total rate is usually at least 10, usually 12 to 15, sometimes even higher than that. That's a lot of money that is accruing every single day. So that is really the challenge. It's just a numbers game. It's just a lot of money that is being paid here and that's accruing. And so now let's say interest rates come down significantly for the 10-year, let's say, down to 3%, which would be probably a best case scenario from an interest rate perspective. My fear is when interest rates come down, that the 10-year treasury comes down that much, which is more than 1% from where we are today, we likely will be in some form of economic distress, which means that, yes, the interest rate, the 10-year treasury might be lower, but the economic environment is not really strong, which means that lenders do not really want to lend aggressively into the marketplace. So your ability to actually get better financing for commercial real estate, including multifamily, might not be better than today, or it could be even worse, right? And that's what a lot of people do not understand. Just because the 10-year treasury comes down doesn't mean that cap rates also come down and that your borrowing cost will also come down. And not many on your call in your large group were probably active during the great financial crisis. But for those of us who were, just as a reminder, yes, the Fed rate came down. Yes, the 10-year treasury came down, but that didn't matter when you wanted to finance a multifamily or a commercial property. you couldn't get financing other than from Fannie and Freddie. So the market was completely frozen for several years. So this is where it's the balancing act, and it's almost like where we have to be careful what we wish for, right? We all want lower interest rates on the longer end of the curve too, but not that low that it actually means a distress in the economy, right? So as a result, I think as long as we have a reasonably strong economy, I do not really see a high chance that the 10-year treasury will come down significantly. And with it, even though they are not completely correlated, there is still a pretty strong correlation that also cap rates will not come down significantly. So that bringing it back to the question of what is the end solution here, I think it is going to be challenging for a lot of these deals and syndicators to get out of these deals with showing a success, not only to get out without a loss for foreclosure, which obviously is a worst case scenario or a short sell, but also being able to return all the capital to the LPs. So that is obviously is everyone's goal, but even that will be challenging in my view for a lot of these deals.
I see. Ryan asked, the top 4 bridge non-recourse lenders last week said they are done extending on bad debt. Lots of supply coming. The Fed will lower rates, but not yet. Have you heard this also?
Yeah, bridge lenders are usually talking a very good talk, right? So they tell you when you talk to them, well, our portfolio is strong, we don't really have that many issues, and it's always the others, right? Once in a while, when you then talk more privately, then they will tell you a little bit more how their portfolio looks like and where the challenges are. And with all the discussions we have with all the major bridge lenders, as well as some of the smaller ones, there is only an element of being tired of loans where they do not really see a chance for a successful exit. And that is certainly what Ryan mentioning is certainly accurate. It's everyone is getting tired, right? So the syndicators are getting tired, the LPs are getting tired, in pref equity, if it's a third-party pref equity, is getting tired, and the lenders are getting tired with the situation. Now, as a lender, you really take a little bit of a different approach here, right? So at least based on what our discussions with the various lenders, as long as you see a chance as a lender that the sponsor group, as it is in place, has a chance to maintain the value of the property over the next year compared to where we are today and not having a deterioration, then the lender may be willing to extend that loan yet again for another year or maybe another 2 years, assuming that the sponsor has the ability to bring in the cash necessary to actually maintain that property at the current level. So that's what we have been seeing, and we actually have helped a number of sponsors with that very successfully. Lenders have extended loans by not just 1 year, but sometimes 2 to 3 years for the right sponsors, right? Where the sponsors were willing to bring in additional capital. They have a relatively strong balance sheet, so they can show that they can inject additional cash to the property as needed. So in those cases, the lenders are still willing to do those modifications. However, lenders are now also recognizing that some of the sponsors, they are so against the wall that if they allowed them to extend yet again for another year, that in a year from now, the property would likely have a higher vacancy, have higher deferred maintenance, would have more debt accounts payables because they can no longer pay. So it's really a downward spiral that the property goes through, and it gets worse for the lender if they wait for another year. So in those instances, the lenders now wake up and decide it's better, we don't want to take over the property, but it's still better for us to take it over, spend our own money for asset management, inject our own equity, and then hopefully can sell it within a year or 2 or 3 years rather than letting it deteriorate further. So that is definitely what we are seeing. I foresee that we see many more foreclosures as well as short sales if a buyer out there. That is definitely what a lot of lenders like to see rather than taking the property back, to have a buyer that can take the property, that they are willing to take a haircut, let's say 10%, maybe more of the outstanding loan amount, and then lend a new loan to the new buyer who is a stronger sponsor who can take over the property and manage that property. So they still have to take a loss, but at least they do not have to take over the property and manage it themselves, which is not cheap, right? So if every property you take over, unless you just say, okay, we take it over and sell it through the foreclosure auction, the reality is most properties, it will take millions for a lender to stabilize these properties. So it's very costly. So this is why it's very often pretty attractive for them if there is a replacement buyer that they can find who is buying the property at the discount of the loan amount, and then are able to finance that party again with a lower loan and take that loss once, but now have a new loan on the book with a much stronger sponsor as well as a lower cost basis.
I see. All right. Let's switch gear a little bit and talk about capital raising. I know in addition to being a lender, sometimes you also go on deals, whether it's JV or co-GP of sort. Share with us a bit about that. What is your buy box like? When do you decide whether or not you're going to get involved in a deal beyond the lending side of it?
Yeah, actually, there are two aspects, right? If a property is already stabilized, my rule is and has always been that if you're not able to get at minimum 75% loan to value from a permanent lender like a Fannie or a Freddie, then in my view, one would overpay for that property. So that doesn't mean that one should actually take out a 75% LTV loan, but at least it should underwrite to that level. So unfortunately, we have seen that many times where it doesn't underwrite to that, and today that is the case. So that's one of the criteria for me when it's a stabilized property. When it comes to value add or distressed properties, that's obviously much stricter. I would say we definitely have tightened that side significantly. I would not go into any deal unless it's where we personally live. Obviously, we live in Dallas, Fort Worth, or in another market where we have a partner we can trust 100% that they are truly the boots on the ground there. And I'm not saying just let's do a little bit of asset management. They need to have very strong experience and position in that market. What we see a lot is, and we just saw yet another syndicator who has had plenty of trouble in the past, but now they are going for a 3 or 4 property portfolio that is spread across several markets. In my view, that's insane, right? This is essentially bound to fail before they even start, because you cannot have the boots on the ground that are really able to support these deals. So that is really my two main criteria. The boots on the ground is really non-negotiable, period. I've seen it now so many times where someone attempted to be in a market where they do not have a strong local presence, and it just doesn't work out, particularly in the current environment. Asset managing from the beach, unfortunately, while it sounds great, it's just not feasible.
Gotcha. Let's talk about fund of fund and fund of funds. You distinguish the singular and the plural in that. And I know you're not a big fan of fund, the singular form. So first, if you can share with everyone the difference between those two, and why is it that you don't like the fund of fund part of it?
Yes. So when we talk about funds in general, right, what most people would understand of a fund, oh, I invest in a fund, that they invest in a fund that is providing them with diversification. Right. So whether it's a mutual fund, whether it's a ETF, whether it's a REIT, whatever it is, that's what generally most investors would associate with, right? So rather than me picking different investments, I invested in a fund and then I'm immediately diversified in that segment that I want to invest in. And that, in my view, is a very good strategy, right? As an investor, invest in one vehicle and have that diversification right out of the gate. Now, when it comes to that fund of fund model, which obviously is really very unique to the syndication space, where you essentially have someone offering an investment in a single asset, and then that investor invests with the fund, which then invests in a target asset that is also a single asset. My question is, what's the benefit for that investor, right? So now, obviously, there are arguments. The fund manager of that fund of fund will do the due diligence. Maybe they will be able to negotiate better terms thanks to a larger sum that is being invested by that fund compared to the individual investor who could not get the same terms. So there is that argument, and I'm not discounting that argument. My main problem with those structures that most fund of fund managers do not really have the ability and capacity to do the true proper due diligence, because the fund size is just not large enough to support that. And on top of it, they just do not have the necessary background to really be managers that are capable of to do deep due diligence. Now, also, if there is anything going wrong, now the investor is one level removed from the target fund, which is another negative point. And as there were a couple of situations where it didn't work out well, and investors in the fund of funds are now removed from the target asset fund, which makes it much harder for them to get the information and to get any view of how they can get out of that situation. So this is really why I'm not really comfortable with these fund of fund models. I know obviously you are very active in that space. If it's done, I think it can be done correctly, but we also need to recognize that it's also about economics, right? Particularly if you have let's say you raise 3 million or 5 million for a single target asset, the cost to do proper due diligence it's comparatively high. And to do ongoing management and monitoring of that for just, let's say, 5 million is just very costly, right? If it can be spread among a larger portfolio, it is much easier to absorb.
And yeah, I know a lot of times in our single asset SPV fund of funds, a lot of times it's under $1 million. So it's even more high.
Yeah.
And yeah, so that's one of the things that we do is we have a few fund managers who would partner with each other, become co-fund managers and help share in some of that cost and be able to do better due diligence. Like whoever might be boots on the ground is driving there, doing the actual due diligence. And by collectively coming in together, we usually get a lot better economics than any one fund managers can get on their own a lot of times. Yeah, we do work our best to try to solve the issues that you're referring to. Yeah, with this side of fund of funds. And
Yeah,
yeah,
I mean, that's good to hear, right? And appreciate that you bring up that topic. Obviously, it's a sensitive topic, particularly for you, since you are in that space and you know that I'm pretty critical of it. So I really appreciate that you bring it up. Again, there are good players and there are bad players, right? And the problem is that the bad players are ultimately causing this space to blow up, as it is with any type of area, right? With the bad players in any area, even when you look at crypto, you have a few bad players and it creates a massive issue for everyone else. So only in that space, I just have seen so many fund of fund managers that all what they did, they took the target assets pitch deck, added another page with their resume on it and their logo, and there it went out to investors. That's not due diligence. That's essentially just being a marketing machine for someone else. And some of these fund of fund managers, I know that they do not really understand enough to do proper due diligence. And that's really where the risk that I see, and obviously it damages everyone who is doing it the right way.
Yeah. And then some of these issues too, there were similar issues in the co-GP model prior to the fund of funds model getting more popularized. And so, yeah, it is definitely educating the marketplace on the right way of doing things so that way we don't ruin it for all of us.
A very good point, right? So I'm not saying that there were no issues on the co-GP side, right? So there are plenty of incorrect ways people were raising money through co-GPs, right? So I'm not saying that one side is only good and the other side is only bad. What I would say is if someone has such a challenge to raise money for deal sponsors, what they may have to consider is and ask the question, is the deal that we are targeting just too large for us to swallow, and should we scale down? Right? Whether it's through a co-GP or through bringing in a fund of fund or multiple fund of fund operators, they really need to ask themselves, is this because we are just biting into something that is way too big? And that's what I would recommend for syndicators, really to think very hard, whether it's worthwhile to go for some of the larger deals or just scale back a little bit. So it makes it easier to actually raise money rather than stretching at every corner and potentially even entering some form of a space that is gray zone to all the way legal.
All right, Anton, we're going to be wrapping up this part of our interview and then open up for any Q&A, for any questions from the audience. But before we take the question, for those that want to reach out to you, connect with you, learn more about peak financing, if they have deals, whether they're looking for debt or they're looking for you to potentially consider partnering with them, where would you like to send them?
I would say I'm active on LinkedIn, I'm active on Facebook. I also will post my information in the chat so everyone can have my contact details there. And my email address is anton@peakfinancing.com. So I'm pretty easy to reach and not hard to get in touch with me.
Excellent. Anton, thank you so much for being on our show today. Really appreciate you coming on and sharing with us your knowledge and wisdom. Yeah, really appreciate it.